All right, well, welcome everybody. We're going to talk today about trading short-term trades for weekly income. Here's the 3-week class schedule, April 3rd through April 19th, that we will be starting. So it will be 2 weeks. No, it'd be 3 weeks from April 3rd. I think 2 weeks from this coming Tuesday, but it'll be April 3rd through April 19th. It'll be 3-week class schedule. Tuesdays and Thursdays we'll be meeting at 1 p.m. Central. All classes will be recorded and archived like we usually do at Sheridan Mentoring. The great thing is you can go to the class page, ask questions anytime during the classes, 3 months after the classes on the material, and that is all good. Class time, minimum 1 hour. I usually go an hour and a half. A lot of times. Class cost $297, and that would be for 6 classes. It'd be approximately 6 to closer probably to 9 hours. And every class that we do, I put on a live trade. So what we're known for with our classes is extremely practical. We're doing it. We're doing these trades through so you can see how to navigate these things so you can do them yourself. Rough class agenda, and I will be tweaking this. Class 1 will be Greeks of short-term trades, our philosophy of short-term trades, and our 4-step risk management plan. Class number 2, iron condors and credit spreads, will focus on that, especially as it relates to the current market. We're in a little different weather condition here in the market than we've been for years. And so we're talking about navigating through that. Class number 3 will be calendars and double calendars. Class number 4, butterflies, when to do one versus the other and all that kind of stuff. Class number 5, adjustments and risk management. And then class number 6 will be designing a plan for $3K a month on $25,000 of capital, which would be about 3% per week. So that would include good trades, bad trades, and that would be the plan, conservative plan, 3%. For people who, for people who've been doing this a while. And so that's kind of a rough agenda. So as we start out, a couple things I want to go over. Here's a 1-year price chart of SPX. So today, SPX is around that 27.55 area, right? What's SPX right now as we speak? SPX is about 27.54. So the environment, here's important, the environment for trading short-term trades, and this is interesting. When we did our first 4K class, July 13th to August 1st, VIX was 9 to 10, right? And SPX was 24.47 to 24.84. So basically, this is the environment. This is the environment that we've been trading SPX during the last time we did a short-term 4K class. And during this 3 weeks, we did live trades during every one. So we were showing how to do it. You can see that's a different weather it's a pretty range-bound weather condition. Then if you look at 4K part 2, when we did it, VIX was 10 to 11, August 29th to September 14th. SPX was 24.30 to 24.98. And you can see, again, pretty range bound, right? So when we were doing, I think these were both 3-week classes, you had ranges of about 40 points and you had VIX very low. Now, the last 4 weeks, if you look at the weather conditions over the last 4 weeks wouldn't really be this, but it would be more like this. We've got a range of 2650 to 2800, which would be 150 points. VIX is 15 to 22. And that's been the last 4 weeks. So So when we did 3-week classes with live trades all the way through that and taught through that, that was a different weather condition. There were some bumps, but it was much easier, right? Here, the weather conditions are a little more volatile, but not as bad as you think, just because we've had two-way movement. So and the VIX has been in a range of 15 to 22 basically over the last month or so. So the key here is I wanted to talk about short-term trades and go over it for 4 weeks when we're in a little more volatile condition, because I think there'd be more learning and showing, how do you deal with these trades when the market's moving around more. So again, these two environments, when we did the original making 4K class, making $4,000 a month on 20, I think it was on 20,000. That was during July 13th to August 1st. VIX was 9 to 10. We had less than a 40-point range. Here, 4K Part 2, VIX 10 to 11. August 29 to 9/14. SPX is in 2430 to 2498, right? And again, 50, 60 points. And this is a different environment. So this would be like driving, these would be like driving in Chicago in the spring, summer, or fall season. And this would be driving in Chicago when it's in the winter. Now, most of the last 3 years, to be honest with you, have been in this environment, right? This environment here, we really haven't had this type of an environment really since the last correction. This is more correction environment. So it's different, but you still have to be very concerned how you're managing trades through it. So this should be an exciting time that we'll be focusing for 3 weeks on managing these short-term trades. So we'll be able to put on quite a few trades and get them off, and put them on during the class. All right. So let's go over a few trades here. We're going to go over a calendar, a butterfly, and the current conditions and talk a little bit about that. Here's a calendar trade in SPX. So right now, when I was looking at this with SPX at 27.55, typically what we would do on a short-term trade is put our shorts somewhere, 7 to 15 days from expiration. So right now what I would do, so this is a trade, today's Friday, so I'm going to sell an expiration 2 weeks from today, right? And if I sell an expiration 2 weeks from today, that would get us to March 30th. But March 30th is Good Friday. So here I am, March 29th, which would be a Thursday because of the Good Friday. So this would be approximately 13 days from expiration on our short, 28 days on our long. That's how we would typically set up a short-term calendar. So we'd put it on, let's say today, if we put it on every Friday, the goal, even though this is a 13-day, the goal is to be out of this by next Friday when we put on another 13-day calendar. So in this case, I'm in SPX. I'm buying 1 April 13, 27.55 call, selling 1 March 29, 27.55 call, and paying $12 debit for this particular calendar. So my longs are going to be about 14 days out past my shorts. And this is, for those of you who aren't familiar, I'm using a TD Thinkorswim graph. So you can see this is the expiration graph, and this is more the graph today, right? And so you can see the expiration graph, you can see this is what it is, and these are your expiration break-evens right here where the P&L line goes through the zero axis right here. Question says, do VIX levels matter on this short-term trade? Do VIX levels matter? I think if the VIX levels were in the 20s mark, it would, but when we're in the 15, 16, 17 level, which we are now, it doesn't matter as much because the theta is really good on these trades. So if I'm doing a shorter term trade, I don't have a problem with a little bit higher VIX level because it's less likely we're going to drop 2 or 3 points in a day when VIX is at these levels versus if VIX was, 20 or 21, we could easily drop 3 points in a day. Leanna says the IV skew is what matters the most. That's not true. No, the IV skew isn't what matters the most on these short-term trades. It doesn't matter that much. What matters the most on these trades is the volatility. The IV skews are going to be pretty standard. Most of the last 3 years in the market, your shorter term options were going to have a lower volatility than your longer term options. And just over the last 6 weeks or so with the down market, that flips it. And so that's just a normal, you're going to just see more of it, but it's not better because ultimately, even though there might be a positive skew right now, what does it mean, a positive skew? A positive skew means the options you're selling are higher than the ones you're buying. But the offset of that is the levels of the volatility are much higher than they were 2 months ago. So IV skews aren't that big of a issue. The key with these short-term trades, again, it's the theta. And we're looking to, like this would be a 13-day trade, looking to get out of this trade, assuming I put it on today at Friday, looking to get out of this trade by next week. So this would be a calendar. And you say, what is the difference between doing a calendar today with VIX 15.63 today, roughly, and doing one when VIX was 10 or 9? Well, a big difference is the calendar, doing a calendar when VIX was lower, your break evens, these things are much narrower, right? So you get more space, more room here. Another trade that's been pretty popular, is the double calendar. We've had really good success with that on live trades in our community for the last 4 or 5 months. Been a little bumpier the last month at times, but we started doing this when VIX was 9 to 11 is an iron condor alternative because again, double calendars are in the same family as iron condors. Why? Because the foundation of doing a double calendar in an iron condor is you're selling an out-of-the-money call and an out-of-the-money put, right? And these can work well in multiple volatility environments, but they worked very well when VIX was 9 to 11. And it's just but they can work when VIX is 15, 16. I think it becomes a little more difficult when VIX gets in the 20s. But again, this is a shorter term trade. So in this example, this was with VIX or with the SPX at 27.57 today. And so what I did was my short options were 7 days from expirations, selling the March 23 and buying the April 6th. So in this particular example, I'm selling the March 23 expiration. That expires a week from today. A week from today. So if I'm putting this double calendar on today for this particular one, my short expiration is a week from today, which would be March 23, and then my longs are 14 days past that. And if you look at the strikes here, I'm putting a call calendar on about 23 points to the upside. And I want to put a put calendar on 27 points to the downside. Again, so this would be a seven-day trade. And I'm looking to get out of this. If I put it on today, I'd be looking to get out of this by Tuesday, probably around Tuesday. Again, a very short-term trade. And you can see the theoretical theta per day. It's very high, and that number grows. So if you have 100 and even 2 days of theta, that's $130. And the debit on this trade is $20.65 debit, which would be $2,065. But again, this is a good iron condor alternative when the volatilities are low. But what I'll show during class is, as long as we're in the teens of VIX, which we are now, I think this works fine, right? You get a little more room than you did when VIX was lower. So these are trades we're going to be putting on live and demonstrating and walking through during the class. We're going to do this all, work on the craft together. So these are just samples of the trades that we would be doing during the live class. Another one would be a broken wing butterfly. And again, here's an example of it. A broken wing butterfly is just unbalanced. So in this example, with SPX at 27.58, I went in and I'm selling two March 26, 27.60 calls. So it goes close to at the money as I can. And all in calls, buying one call 30 points down, one call 25 points up. And the reason I go broken wing, what does it mean broken wing? In this case, the 27.30s are 30 points away from the short call, and the 27.85s are 25 points away from the short call. So it's broken wing. It's not balanced. Balanced would be 27.30, 27.60, 27.90. Where you're buying one, selling two, buying one. This is broken wing, and the reason we do broken wing is to get the position deltas closer to zero. That's where I like the position deltas on these short-term trades, because really the big thing going for you on these short-term trades is theta. And so I don't want to be leaning long or short. I don't really have the volatility risk for the most part on these 7 to 10 day or 15-day trades as I do on a 50-day trade. And so I want the deltas closer to zero, let the theta work for you. So this is a 10-day butterfly. It's a little different. This is a 10-day butterfly with VIX at 1562 today. So the expiration is March 26th. So if we're looking at that, that expires on a week from Monday. So we have different expirations these days. You have Monday expirations, Wednesday and Friday. So this 10-day would be put it on today, Friday, and expires a week from Monday. That would be March 26th. So it gives you 10 days. Again, I'd be looking to stay in this trade to probably Tuesday or Wednesday. And this is a debit transaction. Costs about $10.30, which would be about $1,030. And this is your expiration graph on this. And so these are the types of trades that we would put them on, and we're putting them on all the time, every week. So if I put this trade on today, Friday, the idea is it's a 10-day trade. I put it on Friday. I'm out of it by Tuesday or Wednesday. Next Friday, put another 10-day butterfly on and on and on. Question from Stan said, are you using historical volatility for your P&L graph? No. The P&L graph is just, the P&L graph is done by the brokerage platform based on the options I'm putting in. So I'm putting in buy 1 March 26, 2730, sell 2 March 26, 2760s, buy 1 March 26, 2785. It's currently trading at $10.30 debit. So based on that, the brokerage firm is generating a graph of what that trade looks like at expiration and what it looks like today is the purple. So I'm not using any volatility input into this. This is, live what the trade would look like. And then the last example of a trade that we would be doing, all of these are types of trades we'll be doing and showing you how to do them during the class. And then here's an iron condor. So this example is using another, just giving you a little different expirations. Here's a March 28 expiration. So March 28 expiration is going to be 12 days from now, and it's going to be a week from next Wednesday. So this will be a 12-day trade. And again, on a 12-day trade, I'd probably be in it about 6 days at the most. I'm going to be out of it. Again, the thought process is like if I put it on today or Thursday, but I'm putting it on today, a 12-day trade, probably 95% probability I'll be out of it by next Friday. Next Friday, I can put another 12-day trade on. So in this example, I'm with SPX at 27.58. I'm selling the 28.25 calls, which are approximately, how many points out of the money? 42, 52, 62, 67 points out of the money on the call side. On the put side, I'm selling the 28.65 strike. And what's that? 35, 80, 93 points out of the money on the put side. I chose the short call. The delta of the short call was, I think when I did this, 10. Excuse me, on the call was 10, and the puts 15. By using a little bit higher delta on the puts than the calls, I'm going to get those deltas kind of near zero where I want them. The credit's about $1.50, and because these are 10 wide credit spreads, your margin's going to be the distance between the strikes. It'd be about $1,000 minus a credit of $150. It'd be about $850. So if I was looking to make 10%, it'd be 10% of the margin. And so that's an iron condor. That's the expiration graph. Those are the short strikes. And so again, these are the types of strategies we're going to be putting on during every class and showing you how to do them, giving you a concrete plan how to do it. And the goal at the end of the 3-week class is that you've got the skills to, hey, do it yourself, right? That we've gone through the trades, given guidelines, talked about it. And the nice thing is we're doing this during a little bit different weather condition than we've had in the last 3 years. So it should be an exciting time. Oh, Brett says I have a typo. So 26.85, 15 and 58, 68, 78, 58, 68, 73. So yeah, that'd be 73 points away on the put side. Thanks, guys. And then 67 on the upside. Yeah, and I'll be spending time, in the class that we're going to do, our classes are, they're very practical. Everything will be on the table. How we pick the strikes and all that. But basically, I'm trying, in this particular trade, short-term iron condor, I want to get the position deltas near zero. So my iron condors, it's going to require doing a higher delta on the put than the call. And so that's why I'm doing a 15 delta on the puts and a 10 on the calls. Anyways, if you have any other questions on the class or material we covered today, I'd be happy to help you. Send me an email to dan@SheridanMentoring.com. And otherwise, look forward to seeing you in class in 2 to 3 weeks. Thanks again, everybody. Appreciate it.